Hello and welcome to the Trade with Logic podcast, where you'll learn professional market insights to make you a successful Forex trader. Your hosts for today will be Matty Chung and Marcus Riot from Logikfx, and in this episode we'll be going over retail trader expectations and how most traders are starting their Forex journey with the wrong mindset. So, let's jump straight into it. Marcus, what was your expectation of the markets when you first started trading?
Hey, what's up, mate? That's a good question. So when I first started, probably when I was about 17, so that's going back 6 to 7 years now, I saw an advert for eToro, and they were advertising it as if, you can quit your job, quit university, and make, ridiculous capital. And that was literally my first expectation was, wow, there's literally guys out there that just try to predict the future in terms of financial markets and make a living from that alone. And that was literally my initial expectation, and that's initially what drew me towards the markets, thinking that I could self-sustain myself without having to rely on anybody else, be self-sufficient, make income monthly, trading my own money to make money. Do you know what I mean? What about you, May? What was your first expectation? Was it similar to that, or?
Yeah, well, mine was actually when my parents first started buying stocks, and they'd made a decent amount of money when buying the bank stocks, which had depreciated during the 2008 financial crisis. And then they got bailed out, and then all the stocks rose again. So it was really nice around that time. I was like, ooh, what's this? And my parents called it gambling at the time, but I was like, I've seen films, and they're like making a lot of money out of this. It's like, I might have a look into it.
That's true. Like watching movies, it does put that sort of idea in your head. It's really exciting being a trader, and it's really attractive for a young person because, it's what we seek. Well, that's what I definitely sought after when I was younger, is an exciting lifestyle, which suits my sort of educational background as well. So hand in hand, it seemed like a great fit.
That's true.
Yeah.
And how does it compare to now? So like, what are your expectations now compared to then?
That's a good question as well, because now it's the complete opposite. The more I got industry experience, the more I looked at how you could say industry leading participants were trading the market, my perception was completely changed. I initially thought, okay, hold on, I can make money sitting in front of my computer, looking at a price chart, a few pretty patterns, and make a quick buck, or maybe even make an income from it. And then when you draw a comparison to what professional traders actually do, and by professional traders, I mean people that work in hedge funds or people that work in investment banks on the prop side of it, completely different approach. They don't trade for income, which sounds ludicrous on the face of it, but they actually don't. So it's just one of those things. Do you know what I mean? Where
they're already paid that income, their salary.
Yeah, that's it. They're paid a salary from the institution that they're working for, and essentially their trading goal is to just grow their assets under management, you know what I mean? And whereas a retail trader, which my initial sort of idea was, hey, I'm going to grow my capital and withdraw from my account, which now I understand that it's, impossible to do. The way drawdown works, the way all these different things work, it's just it sort of crushed my inspiration when I first heard of it, but then I sort of understood what trading's actually meant for, which is to grow money till retirement. And then that's what drove me now to improve on that side of trading, like the correct mindset, and not go for like the narrative push by brokerages, which you can probably give a shed ton of information about, on how the brokerages literally push that agenda. And that's why both of our probably initial assessments of the market were it's gambling or short-term returns, that sort of outlook.
That's it. The industry itself is built on a whole narrative where the brokers are expecting you to trade as much as you can and making their money off of commissions and spreads. It's a big thing.
Yeah, so when did you first start trading in terms of going through or what we call now the broker narrative, so the short-term mindset? When was the revelation for you, and how did it actually change your outlook on the market?
Well, within my first year of trading is when I was like trying to educate myself properly, trying to get all the information out there. And within that time, I was actually leaning towards the narrative. And I didn't realize it at the time until I started exposing myself to other methods out there that are not just from YouTube, not just from free educational sites out there, but from institutions like hedge funds and asset managements, how they actually trade.
It's probably good, actually, at this point, to explain to the audience what we mean by this, broken narrative, which is, like you said, Instagram, YouTubers, all of that stuff. What we're talking about here is, you've probably noticed it yourself, anybody listening to this, is you scroll down Instagram, you look at adverts, and you'll see people saying, quit your 9 to 5, make money as a trader, and essentially pushing this idea that it's a full-time job, outside of working for an institution, outside being paid a salary by an investment bank or a hedge fund manager, that you can actually make a career from it. And the reason they're pushing that is because they have this conflict of interest, structurally driven narrative to make people trade a lot. So the way a brokerage makes money is from commissions, right? Commissions and spread. And the way you maximize your revenue as a brokerage is say, hey, go to the general public, convince everybody that there exists a profession where you can just trade the markets and make money from it, so that they trade every day, and that this sort of idea exists. And then you maximize your revenue as a brokerage. And then you also employ educators or blogs, website, news outlets to push this agenda further, which started about 30 years ago when, online trading started to come into fruition. And you are here where we are today, where you've got a whole industry built up on day trading and sort of pushing that high reward for the brokerage, literally low reward nothing for the retail trader agenda. And that's what we mean by the brokerage narrative that I was asking Matty about. So yeah, there's the insight.
And that's where that 1990 concept comes in, right?
That's it, yeah, that 1990 concept, which it's hard to believe when you first hear it. I've mentioned it to a few people before. They don't believe it's quite true, because when you're looking at the industry from the outside, everybody seems to be making money, right? The retail market, at least. But then when you break down the numbers released by the SEC or government reports, and the brokerage themselves now legally have to actually show how many of their accounts are down at any one time, it's literally from the 70% to 90% of retail accounts are down at any one time. It's crazy.
Super transparent now. Well, in terms of retail traders losing, they have to do it by law, right?
Yeah, to essentially try and protect from this sort of the whole topic we're trying to talk about, which is this misconception, these expectations of high rewards over a short period of time, and taking it from there, which is disheartening but also exciting at the same time once you know what to do after, which we'll probably get onto later in the podcast. But yeah,
the initial motivation for people is that unfortunately not true narrative, isn't it? Be a millionaire, you're gonna get this done in like 3 months, quit your job, things like that.
Yeah, it is. And it's unfortunate because they're prying on the sort of quick fix mentality. There's always going to be an audience for that sort of advertising. If I approach someone in the street and I told them you can sit in front of your computer all day, which they are currently probably already doing through social media, just looking at Instagram. So to them, it's like, I don't have to change my lifestyle much. I'm always on my phone or computer. And then look at a few charts and either copy trade, which is a really popular instrument right now. So you can just copy the professionals, which by the way doesn't work, which we'll probably break down in another podcast, and literally have to put in minimal work effort to achieve the goals that they've always dreamed of. It's an ideal scenario for literally majority of the general public. And when something's too good to be true, it generally is. It just comes back down to that, really, to be honest. What do you think, May?
That's it. That's definitely right. You'll see it out there on social media, on Instagram. People, I don't know what it is, but when people print screen their balances on their phones with like a fresh account, they're just completely blown away and they think, oh my God, this guy's a genius. He must predict the market every single time.
Yeah. You know what it is? Prying on that sort of knowledge gap, as we term it in Logikfx, right? That sort of the difference in, when you look at something new and that you don't understand it, it's very hard for you to come up to a sound conclusion when you're looking at it. You'll be looking at it thinking, I don't actually know if that's incorrect because I don't have any domain knowledge on the sector. So my natural port of call for most people this is to think, he's made money, so it must be true. Where the question should be, where did that money actually come from? Is it from what he's actually telling me, or is it from alternative conflict of interest sources, which are pushing an education service or pushing to join a brokerage where they've got agreements with a brokerage where they get paid based off volumetric trade sizes, stuff like that. Those sort of questions don't run through the normal person's mind because they don't have the domain knowledge to know to ask those questions. All they can do is a simple formula. He's telling me something. Does he drive a nice car? And does he have the rewards of based off what he's telling me? And if those two add up, it's very hard for them to break it down without the sort of in-depth research, you could say. So I can see why people fall. I see why people fall for it. Do you know what I mean? But at the same time, it's kind of sad, and we're trying to. The whole point of this podcast is.
So the main population, or the main majority of forex traders, they have that outlook of materialistic items as their goals, right? That's what you're trying to say.
Yeah, and that's what entertains everyone's. It's what everyone can relate to. Everyone in the Western world is looking for some sort of material gain, even though obviously people like to be humble and try and push that side of their personality. The reality is, without money, you can't really do much anyway. You need to put food on your table, and you want to be able to achieve the best future for your family possible. And the only way to do that is to have a wealthy lifestyle. And if you could go to a consumer and say, I can offer this to you, it's everything someone in the Western world wants. Even in the rest of the emerging economy, it's something that they really want because it's logical. It's the way they can achieve their goals.
Selling the American dream.
Yeah, pretty much. Selling American dream.
That's pretty
much it. Yeah, that's it.
So, what do you think the real expectation should be like?
The real expectation, it's pretty much down to what is the Forex market actually there for. So first you need to look at why does it exist. So essentially you got like a foreign exchange market. Forex stands for foreign exchange. A bunch of people exchanging currencies, and you've probably already heard 5.3 trillion or whatever is traded daily. So an absurd amount of money, the most in any financial market. And the major participants of that are your investment banks, your commercial companies, which are like exporters and importers. So if you're on like, I don't know, a metal factory and you're going to import metal from Japan and you're a British company, you have to exchange your currencies to purchase it from Japan because in Japan they only accept the Japanese yen. And all of these influence currency exchange rates. So then the first step you should look at is, right, who are the major participants and who are the ones that drive the price? That's your first step, really, to start your journey on what my expectations would be and what's the purpose of the exchange rate. Once you've got a firm understanding of that, you'll come to the conclusion. So I'm not going to break it down right now because I could talk about it for 2 hours. The conclusion is that the exchange rate is driven by fundamental purposes for economic sort of growth. So the Bank of England is looking to make the exchange rate favourable for the British economy. The US Federal Reserve is looking to make the exchange rate favourable for the US economy, and that's by manipulating it to be beneficial for the companies within that country or the economic region. And then once you've got that sort of outlook, you can say, right then, if those are the reasons, then we need to look at the participants who trade the most money based on that and whose objectives over the long term is to speculate on it to a degree based on true fundamental sort of real things that are happening in economies, exports, imports, base rates, and see why they're making the decisions and how much money they're willing to risk and making those decisions. And the answer is you look at hedge funds or the prop side of investment banks, because these guys are what we could call the professional side of retail traders. They pretty much have the same objective, right? Objective of a retail trader, make money, use your own money. Objective of a hedge fund or investment bank is, well, the prop side of investment banking is to make money using their own money, except for the outcome for the hedge fund is that they're looking to sell the fund after 10 years to a investment bank or a larger hedge fund so that they can just make a return on their initial invested capital, which is another story. But the objectives are essentially the same. So that's your first step, really, to starting your grounding of, right, Now I know where to look for my expectations. Not the Instagram traders, not the brokerage, the online free education sources. They all have a conflict of interest, a structural conflict of interest. So if you start looking there, you're pretty much going to go down a slippery slope of never making money. So you start to look at the professional side of the industry, hedge funds, prop side of investment banks, and that's where to start.
So that's where the true expectation should be.
Yeah,
so,
that's it.
In a summary, what you're trying to say is, if you're going to use your own money to trade, it shouldn't be for income, but to build wealth and something for retirement.
Yes. Essentially, the idea of what's pushed, you could say, by the brokerage agenda, the narrative, is that you can trade for income. And the reason that doesn't work is because if you're trading your own capital and you're looking to withdraw from that capital, you get something called drawdown. Your money is being taken out of the account. So, simple example, you're trading with 10 grand. After a month, you make 1,000. You withdraw 1,000. You're back at 10 grand. Next month, with that 10 grand, you trade again. But this time, you lose a grand. Or let's say you lose 500. You lose less, right? So you're on 9,500. But you also have to withdraw £1,000 again because you're using it for income, right? You're using it as a resource to pay for your living costs. That's what income is used for, right? Your daily expenses, whether that's liabilities, whether that's providing food for your family, your mortgage repayments, anything along those lines, which means even if you lose that month, which is highly likely because the best in the industry lose on inter-month basis. They won't have a consistently profitable scenario where month 1 they make a profit, month 2 they make a profit, month 3 they make a profit, and that carries on consistently. They'll always come in clusters and you have strings of losing months. That's why sort of looking at it on an annual perspective is really important as well. But yeah, it comes down to you want to be looking to grow your capital for retirement and not for income, because the distribution of returns are not even. You're not going to be profitable every month. So if you withdraw every month, your account balance always tends to zero, and there's no other scenario to go around it. And that's where you screw yourself as a retail trader, having this idea that you can actually withdraw from a trading account. Even if you're the best trader in the world, it's just not going to happen. Do you know what I mean?
Yep, I get the point.
Yeah.
There's a big misconception in the market. So.
It is. And with a sort of a good example is I had a friend, right, going to the casino, because I enjoy playing poker. It's an odds game, a bit like trading. There's a lot of similarities, something I do in my spare time. And when I go to my poker tournaments, some of my friends come along and they're playing roulette during the time I'm sitting there, and then they'll come to me with sort of ideas and schemes, or I can beat the roulette system, where the odds are against them and they don't understand how the distribution of returns and streaks work. And then that's what the retail trader falls into the trap of as well. They think with a sort of 50-50, well, in roulette it's slightly less than 50-50, like 47.5, that if they choose their bet sizes and switch the colours, that they can have an edge. But what they're missing is the risk to reward, and the success rate means that you're going to have a coin toss every time, or just less than a coin toss, which means you could have streaks of 7 of 8, and those are streaks of winning and losing streaks. And if that happens and you're looking to withdraw, there's no other scenario where you're not bust over the long term. It may work over the short term. You make money over for a few months. Long term, not so much. So it's very similar to how the casino works in a sense. Short term trading, looking for short term rewards on monthly terms, income just doesn't work. You need to have a long term perspective. That's what the professionals do. The hedge funds literally have positions from 1 to 18 months, right? And the retail traders are pushing the agenda of making multiple trades a day. Why is that? Which one makes money? Those are questions you should be asking yourself as a retail trader. Sort of, if my expectation is to make money, and the professionals are trading on way longer time horizons, and they have up to 25 to 50 positions open at any one single time, whereas with a normal retail trader, they're looking and they have 1 or 2 positions open at any one time, and they close them multiple times within a day, paying commission every time they do this, by the way. You can see why one side loses 90% of the time, and the other side, for example, like Goldman Sachs, they've been around for 100 years, so which one is going to be profitable over the long term and which method would you choose to learn from. It's like any industry you walk into. You're not going to walk into playing tennis and not look what the best tennis players are doing. It just doesn't make sense. That's the best way I could put it. What do you think, Matty? So what's your sort of outlook in this whole scenario on what's the expectation for the retail trader?
I definitely think with the rise of different social media platforms such as Instagram and YouTube, people are flexing a lot of their lifestyles that they get, but there's actually a hidden agenda behind this lifestyle where they're not funding this lifestyle from a trading, they're funding it through other means. They already have built an income either from a business or doing some sort of affiliate marketing.
Yeah, so that makes sense.
You'll see a lot of Instagrammers, they'll have an affiliate market with maybe a broker to get you signed up, and then they'll be making money from you trading, even though they don't trade to make money, but they'll be flexing their lifestyle, basically from the money you're putting into the broker, who then the broker is paying the influencer.
So it's just that structural conflict of interest again, isn't it?
And that's it. It's just that IB agreement, that structure of conflict of interest, and it's a big thing. It's changing people's perception of the market, where if they're not exposed to a professional aspect, then they'll never really know, and that's the sad thing about it.
That's true, and I think it's also important to reiterate here what you should be expecting the professionals to be. So in your head, if we're talking about professional traders and you're thinking about the way like the movie narrative is, they're running around on a trading floor, it's really exciting, all of that BS that's perpetuated to make it look like they're doing loads of stuff during the day, that sort of image in your head, that's market making. That's not actually trading. That sort of rushing around, is something that is pushed into the public to make them believe that it's a very exciting, very active intraday sort of thing, when it's really not. That's just them pricing assets. Literally, what market making is, short-term definition, really rich people go up to the hedge fund and say, invest my money, the investment bank, the market's making side of the investment bank, here are my trades, execute them at the best price for me. So these guys that you're seeing on TV, they are essentially the brokerage, but an institutional brokerage, running around trying to price the assets to give the best price to their clients, which are high net worth individuals and hedge fund managers. That's literally it. A completely different objective to what the retail trader wants to do. But they try to push it as the same thing. So what happens is, a bunch of people, including myself back in the day, looking at this, thinking that's what I should be doing as a retail trader to make money from the markets, when it's not. They have a completely different objective in that scenario. Those intraday trades that you're looking at on TV, they're for market making purposes in movies. They're not for converting their own capital into capital, which is what we're trying to do. And that's the stuff that's not on TV because it's boring. You're managing portfolios of 25 to 50 positions, adjusting exposure. You'll be looking at it, but you won't be clicking many buttons throughout the day. You'll probably be assessing market volatility and looking to maybe adjust exposure, but there's not much you'll be doing. You could be sitting there for 12 hours, but you don't click a single button because no opportunities arise and no risk has arisen.
That's true. I think I remember, was it George Soros? He mentioned that good trading is boring.
Yeah. It's like with anything. Good driving's boring. There's an analogy where Formula 1 drivers, the less you move your hands, the better driver you are. Same with trading. Do you know what I mean?
Yeah, that's true. That's true.
All the work, yeah. Sorry, go on.
Yeah, is there any other summarized points which you could get across before we conclude this podcast?
Yeah, okay. So to conclude this podcast, let's do a strict comparison between what a hedge fund manager is doing and a typical retail trader and show a sort of contrast in the expectations. So the approach of a hedge fund manager, he has a long and short positive selection portfolio. They use quantitative strategies that last 1 to 18 months, with most of their positions lasting around 3 months. Compare that to a retail trader's approach, very short term. They're searching for a day trading sort of manual analysis or signal, and they usually make multiple trades a day, and their risk is concentrated. Now bear in mind, this approach is where 90% of the retail traders lose. And then on the other side, with the hedge fund managers, they have a large diversity of assets, 10 to 50, and they have strict risk management rules on exposure, maximum exposure, and they already forecast on their annual return so that their clients know how much they should expect to be drawdown wise losing maximum through the year and how much they're making. So a hedge fund would, if you approach a hedge fund with a £50 million, you said, right, this hedge fund, our maximum volatility risk will be 5%, and we're going to aim to make 12%. So you know you'll never lose more than 5% in that year. You ask a retail trader to forecast 12 months ahead and how much volatility risk they're expecting, he can't give you an answer because they're short term, they're binary, they're looking on a trade by trade basis as if it's separate from their portfolio every time. When your portfolio is like a big pot, it's like a savings account. In a sense, your trading account is an asset itself that you're looking to grow. And I think that sort of contrasting mindset needs to be put into place. And those are the key points.
So basically a savings account which you never take money out of, but you control the interest rates.
That's a great way to put it, mate. That's exactly what your trading account should be. And the only time you look to withdraw is when you retire, you don't want to work anymore, and you're looking to spend your money from that. If you're looking for income, invest in fixed income assets or a stock that pays you dividends. Then you can probably take some of the income from it. Your trading account, where you're looking for returns to grow your capital, don't withdraw from that. You know, you're just going to lose over the long run. And I think that's a really important point to take from this podcast. And I feel like it's something that retail traders aren't fully aware of. And hopefully then they now will be. Is there any sort of points you want to add to that? Is there anything that I've missed out? I don't think there is.
I think you've concluded it really well there. Yeah. Thanks for summarising the points there, Marcus. And any of our listeners out there, make sure to tune in to our next podcast to see if you learn something new. And if you have any requests on what topics we could cover, feel free to comment them below and me and Marcus can go over them. If you haven't already signed up to our website, make sure you do. You can access some free analysis and education, and subscribe to our YouTube, and make sure to follow our Instagram and Facebook pages.
Bye guys.